Apple Card is the perfect credit card for every purchase. It has cashback rewards unlike others. You earn unlimited daily cashback on every purchase, receive it daily, and can grow it at 4.15% annual percentage yield when you open a high-yield savings account. Apply for Apple Card in the Wallet app on iPhone and start earning and growing your daily cash with savings today. Apple Card subject to credit approval. Savings is available to Apple Card owners subject to eligibility requirements. Savings accounts provided by Goldman Sachs Bank USA. Member FDIC. Terms apply.
Remember back in 2020 when no one was leaving the house and everyone who could afford to was ordering their groceries online? Well, that was Instacart's moment. Use of the online grocery delivery app soared, and a lot of people thought it would never end.
Investors thought that the pandemic growth that a lot of these online companies were experiencing was going to last forever. This was a fundamental change to consumer behavior. This accelerated 5 years of tech growth. That's what a lot of them believed. And we've seen this over and over and over with these quote unquote pandemic winners like Zoom or Etsy or Peloton. That growth comes down almost as fast as it spiked when people get back out there in the world and resume to the kinds of behaviors that they did before the pandemic. And so Instacart experienced that as well.
That's Erin Griffith, who reports on tech startups and venture capital for the New York Times. She's been covering Instacart on the lead up to their IPO. The company's been on a bit of a roller coaster since 2020.
They had to evolve after the pandemic. They saw their sales sort of drop a little bit, and they expanded into a few other lines of business. So in addition to just doing that same thing of delivering your groceries to you at through a mobile app, they also are serving you ads. And they are also making software that they sell to grocery stores to help them manage their inventory better.
Somehow this led to the company doing something that a lot of its so-called gig economy peers haven't pulled off. In the first half of the year, Instacart turned a profit of about $242 million. And then this week, they actually went public.
So the fact that they went public at all is a victory because the IPO market has been in a real slump for the last almost 2 years. There's been no IPOs of note until last week when ARM Holdings went public. That was a spinoff of SoftBank, and that one did fairly well. So that got people a little bit hopeful that more IPOs will be around the corner. No one wants to be first when the IPO window appears to be closed and investors are no longer interested in hot, fast-growing, cash-burning tech stocks. But that might be changing.
Instacart's debut on the NASDAQ under the ticker symbol CART. That's cute, right? It was decent enough. The day the stock went public, it popped, jumping 40% higher than the initial offering price of $30. But since then, it's come back down to earth. And as of early Friday afternoon, the stock price was back to about where it started. Not a great sign.
The issue is that price is still not that good. The fact that they went public at all is actually, they pulled it off at least. They managed to do it. And a lot of other companies, I think, would not be able to go public right now.
So today on the show, how Instacart managed to snatch victory from the supermarket of defeat, and what this means for tech startups struggling to make it in a post-pandemic landscape. I'm Emily Peck, filling in for Lizzie O'Leary, and you're listening to What Next TBD, a show about tech, power, and how the future will be determined. Stick around.
Apple Card is the perfect credit card for every purchase. It has cashback rewards unlike others. You earn unlimited daily cashback on every purchase, receive it daily, and can grow it at 4.15% annual percentage yield when you open a high-yield savings account. Apply for Apple Card in the Wallet app on iPhone and start earning and growing your daily cash with savings today. Apple Card subject to credit approval. Savings is available to Apple Card owners, subject to eligibility requirements. Savings accounts provided by Goldman Sachs Bank USA. Member FDIC. Terms apply. Apple Card is the perfect credit card for every purchase. It has cashback rewards unlike others. You earn unlimited daily cashback on every purchase, receive it daily, and can grow it at 4.15% annual percentage yield when you open a high-yield savings account. Apply for Apple Card in the Wallet app on iPhone and start earning and growing your daily cash with savings today. Apple Card subject to credit approval. Savings is available to Apple Card owners, subject to eligibility requirements. Savings accounts provided by Goldman Sachs Bank USA. Member FDIC. Terms apply.
Tech companies have been trying to break into the grocery business for a long time. In the late 90s, a company called Webvan got a lot of attention.
You have the right to be in your house when a delivery is made. The right to open your front door and be met by a friendly face. And the right to have someone else unpack your groceries. You have the right to the good stuff. Brought to you by Webvan.
They wound up filing for bankruptcy in 2001 after the first dot-com bubble burst. Amazon has famously been going after the grocery market for years. When they bought Whole Foods in 2017 for $14 billion, it was supposed to be the moment that tech finally shook up the supermarket business. It wasn't. Groceries might seem like a weird market for tech companies to obsess over. Milk, bread, and eggs are hardly cutting-edge products. But according to Erin, there's a simple explanation.
Tech companies love a huge market. You know, $1 trillion TAM, which is total addressable market. They love the idea of like, oh, if we could just own 1% of this market. And groceries is an enormous market. The problem with it is that it's extremely low margin. It's really hard to make money. I mean, grocers struggle to turn a profit as well. But yeah, everyone has to eat. It's a really big, repeat purchase thing that every household does. And so why wouldn't it adapt to the on-demand economy? The difference between Instacart and perhaps Webvan and some of the other attempts, the early attempts that blew up, is that they don't own their own inventory. And that's sort of the beauty in general of the gig economy model, is that they don't have to, have warehouses full of groceries that are rotting. They're kind of like a middle man that owns the app and owns the workers who go into the grocery stores, get so they're almost like a service provider. And they have to keep the grocers happy and make them feel that they're not competing directly with them. And they have to, keep their costs low enough that customers think it's worth the fees to get that convenience, get their groceries delivered.
So that they kind of bopped along, and then the pandemic hits and their business kind of takes off, basically.
Yeah, if you look sort of at their business, I want to say it grew like fourfold maybe.
Wow.
In 2020, it was just, no one was going to the grocery store. Everyone was trying to get everything delivered. That didn't last that long. Once we all started leaving the house, even before the vaccines, people were at least kind of starting to return to the grocery store, maybe not as frequently, but they would wear masks. And then by the next year, their business kind of fell off a cliff a little bit. It wasn't that it was flat. It was like it was actually dropping. And if you're a high growth tech startup, that is kind of like death. Your whole story is that we're growing and growing and growing, and there's nothing but upside. And so if your growth is flat or shrinking, you need to figure out how to turn a profit.
All this led to turmoil at the company. Instacart founder and CEO Apoorva Mehta was forced out by Instacart's board of directors in 2021.
The founder, Apoorva Mehta, called up his competitors and kind of tried to see if maybe they're interested in buying the company. He talked to Uber, he talked to DoorDash. The board was not super happy about that. It was, maybe a little bit of a kind of reckless move, or perhaps seemed erratic. And he eventually stepped down from the company, and they brought in Fiji Simo to replace him as CEO, she was a longtime exec at Facebook. She ran the Blue app. She obviously is very well versed in the advertising industry, and she kind of went on this tour, meeting with grocers, trying to get them comfortable with her and their partnership, trying to strengthen that partnership with them, because she knew obviously how important it is to make sure that these grocery chains welcome Instacart and their shoppers into their stores and let people order from them through Instacart's app. So yeah, there was a little bit of a rocky moment where this company that had been created by one person and grown up till this point had to kind of switch gears to new leadership.
So it was Fiji Simo who sort of pushed the advertising part of the business forward.
Yeah, that had been in the works. But you really start to see the growth of it. I think after, like, the product had been building, and they had always had that plan. But and you can kind of look at their revenue and see that it really started taking off and being a more meaningful part of their overall sales, over the last year and a half.
This focus on advertising is a big reason why Instacart was one of the few gig economy companies to actually turn a profit. Nearly a third of its $2.5 billion in revenue last year came from its ads and software division. That's according to the company's filings to go public. Sounds like a great diversification plan, right? There's a catch.
It's sort of a challenge because if you don't have any customers that are shopping in the app, you can't show them any ads, right?
Yeah.
So these businesses need each other, but you don't want to turn people off. Like if you search for milk and you only saw almond milk, you might think, oh, they don't have regular milk.
Yeah.
And so there is a little bit of a balance of like how many ads they can show and how much money. I think they're kind of testing the boundaries of like, okay, how much can we be advertising to these people where it's still seen as helpful and not annoying or distracting or even like turning people off. And that's, I think, a challenge for them, because if they do that, then it's like kind of a downward spiral. People leave the app, there's no one to advertise to. So yeah, it's kind of like this, the core of the business is still the delivery thing, but they've got this sort of like layer on top of ads that helps them to actually turn a profit.
And are they doing anything with all the data they're getting from all their customers? I think about this every time every time I go food shopping, they ask me like, do you have a phone number with us? And I just mindlessly put my phone number in because I don't want to offend the cashier. I know it sounds ridiculous. And then nothing happens. I don't get any discounts. And I think, oh, I've just told them that once again, I'm buying bananas or Gatorade or whatever it is. Like they know so much about me. What am I doing? What are they doing with the information? Anything? It seems like another area where they can make money.
Yeah, I kind of agree with you on that. I hate when I sort of see Amazon's accounting of like everything I bought at a Whole Foods or,
Yes.
I don't necessarily want that record. Like I don't need to see it. And I don't, and now I know that it's, you being quote unquote used against me
It's out there.
get me to buy more things, or at least just people know my habits. Yeah. I don't love that necessarily anyway. I mean, that is sort of the world we live in though, where we trade convenience for surveillance. And that's, I guess, another example of that. But sure, yeah. If you've bought bananas once a week, every week, like they could in theory send you a push notification being like, need some bananas, or they could in theory, be serving that up to you. Like, here's your last order. So like, yeah, there is a lot of kind of optimization that can be done there. And obviously Facebook is the king of that. When you see the most hyper relevant ads in the world on Instagram that could only be tailored to you, they kind of invented that in a way. So yeah, it makes sense that they'll be trying to capitalize on that.
And all the deals they've done, all the goodwill with the grocers, the Krogers, what's to stop those companies from just doing their own delivery business and cutting out Instacart? Is that like an existential threat for them at some point?
I think the bet is that these companies, don't have that tech DNA. They obviously, every company is a tech company to some extent now, and they have to integrate and they have to have their own systems. But this is a way for them to not have to deal with that. There was the era when every media company was trying to build their own CMS because they thought they could, make it custom to what they needed and not have to pay some provider to do it for them. And that ended up just being a huge boondoggle and waste of time and money. And it was easier to outsource that to a company that has more expertise on that. So, I don't know. I think that's probably the Faustian bargain that a lot of these grocers are making with a company like Instacart.
When we come back, what happens when Instacart doesn't just need to keep its customers happy, but Wall Street too? Hi all! Wondery's podcast Business Wars is back with an incredible season that you'll want to listen to. It's all over the news, but did you know that as early as the 2010s, the dream of artificial intelligence became real? The big tech companies knew they'd have to harness this technology if they were going to win the new AI race. In fact, it was key to their very survival. But researchers within each company would soon sound the alarm that if the tech giants moved too fast, the consequences could be devastating. In their latest season, The Rise of AI, the tech behemoths fight to dominate the artificial intelligence space and reckon with the costs. Follow Business Wars wherever you get your podcasts. You can listen ad-free on the Amazon Music or Wondery app.
Critics are calling The Creator a masterpiece.
Joshua, take care of her.
I promise. It's the best film of the year. Phenomenal. The best sci-fi film in ages.
They're coming to get me.
I'm getting you out of this.
The Creator is breathtaking in scale and vision. It's mesmerizing, visually stunning. See this film on the biggest screen possible. The Creator, rated PG-13, may be inappropriate for children under 13. Only in theaters September 29th. Get tickets now.
Hey, TBD listeners, it's Lizzie. Thank you so much for listening. And if you want to support what we are doing here, the best way to do that is to join Slate Plus. It's Slate's membership program. You get all your Slate podcasts, including this one, ad-free, and all sorts of cool extra content on the Slate site. So just head on over to slate.com/whatnextplus to sign up. Again, that is slate.com/whatnextplus. Thanks.
What do you think are the challenges now? What are you watching now that the company is public?
Well, investors obviously care about profitability, and the company has shown that they can be profitable. They had a whole profitable year last year. I mean, Uber, Lyft, and DoorDash have not pulled that off. So that's great, and they're going to have to keep that up. But the other question then is just the growth. Like now, everyone has tried Instacart or tried online grocery, and a lot of people have gone back to the old way of getting it themselves. And so can they lure those people back? Can they find new users? Can they find new partners? That's actually the challenge. And it's kind of a backward way to look at what should be considered a quote unquote growth stock. They are technically a startup that just went public that should be on the beginning of their journey. They've been around for 12 years. They are profitable. And, are they a value stock? Like, not really, because there's still a lot of potential there. And I think so they're selling that message they're selling a message that they kind of turned it around post-pandemic, that they are actually turning a profit. And then they have all these new avenues into the grocery industry that are not just their core delivery business. They're growing by selling software. They're growing by selling ads. So I guess that's kind of what we're looking for. But the grocery business in general is like notoriously low margin and difficult. So they're never going to be, I think, one of those like exciting, like, oh, what amazing, like flashy new technology are they rolling out kind of companies. But, they're going to kind of like plug away and hopefully become an important pillar of the grocery industry. That's what they hope, at least.
Is there any lesson here for the other gig economy companies or the other pandemic boom companies? Like, could they pull off similar profitability shifts?
It's interesting because Uber and Lyft have tried ads. you're waiting for your Uber and you're looking down at your phone constantly to see where it is, and they're throwing you an ad, which I think users probably find very annoying.
Yeah.
And they can, restaurants can buy ads and Uber Eats, for example, but they don't have those relationships with the companies that Instacart has, where, a company like companies like PepsiCo have enormous advertising budgets, and Instacart is getting them at the checkout counter, essentially. So that is a pretty valuable lever that Instacart has that some of the other gig economy companies don't. And for the rest of the gig economy industry, like, there's not a lot left. There's been a huge shakeout of a lot of these companies. They Postmates sold, Grubhub sold. There has been mega consolidation, and a lot of companies have kind of just failed or not lived up to their promise and their valuation. So there's kind of only a handful left standing there. And then on the pandemic boom, I mean, yeah, that's just kind of a lesson that's continuing to play out. The lesson being that a kind of once in a lifetime behavioral change of all of society happening at once is not necessarily going to last forever.
Yeah.
Next time that happens in this lifetime, that we can keep that lesson. I mean, I think maybe one of the lessons to take away from the madness of that moment was that in the first few weeks of the pandemic, everybody freaked out oh my God, the economy is in a free fall. Everyone was laying off. Everyone was cutting. And, it only took 3 months or so for tech to realize, oh, actually, we are winners. This is good for us. And holy crap, we need to put our foot on the gas. And I think that sort of fake out actually gave a lot of companies a false sense of security, because it's oh my God, we had this near-death experience and it's actually good for us. So we should. And so I think there's an instinct amongst some CEOs and founders to when the entire world panics because things are going badly, to suddenly put their foot on the gas and be nope, this is good for us. And that is not always the case. I think sometimes, for example, this kind of slow and steady downturn we've been experiencing with inflation and high interest rates, and just sort of general stock market slump has actual pretty serious implications, in that the tech industry is kind of in a downturn. And there have been some founders who have been a little bit in denial because they're no, it'll bounce back. This is good for us. And that's not necessarily the case.
I mean, the Nasdaq's doing pretty well this year.
It's true, but not a lot of the money losing tech companies have been riding that wave. There's a lot of companies that went public in that boom that are doing very, very badly in my sort of small cap world.
So is the gig economy kind of over now?
Yeah.
Really?
I mean, no, but it's similar to if you think about e-commerce as a problem that has been solved. I think the gig economy has been solved. There aren't gonna. I could be wrong. I'm often wrong. I'm not an investor. I'm just a journalist who's observing from afar. But I don't think we're going to see a new gig economy company springing up. We've got DoorDash, the ones that exist, DoorDash and Uber. They are expanding into more and more areas. We've tried it all. Back in 2013, 2014, there was an on-demand company for everything. There was literally an on-demand butler company. You could get an on-demand lawyer at the tap of a button. And those things have shaken out to, some of them are fine businesses, but they're very small, maybe not billion-dollar businesses. Some of them, could never make the model work. And some of them are plugging along, but I don't think we're going to see new ideas coming to that category. It's been sort of the cycle has played out.
So IPOs, after not happening for 18 months or something, they're finally happening again. You mentioned Arm, the British, the UK chip designer. There was Instacart, and Klaviyo, as we're speaking, is going public. Is this a sign that the market's back for tech companies, that people believe in them again, that investors believe in them again?
I think that there have been a lot of companies on the sidelines that have been wanting to go, and they kind of missed the window. And have just been keeping their their S1 filing warm for the moment, for the window to just crack, and then they're going to kind of like kick it open. There's a number of companies that are ready and want to go and will probably try to rush out before the end of this year, having seen these companies go out and do okay. I think the thing that these three companies have in common is that they're all profitable. And that's what investors want. They don't want, like, in 2021, like, there were a lot of companies that had literally $0 of revenue that went public via SPAC. So, like, we're never going to see that. But there are a number of companies that are ready and that are, like, good, solid companies that I think will try to go. And then next year, I think it remains to be seen if we're going to start seeing, like, a lot of companies to go public, because again, there's that profitability thing, and like so many of the companies that are valued at $1 billion or more are far from turning a profit, and that is, I think, going to be get a chillier reception from investors. So, like, I think things are like starting to open back up, but I don't anticipate we're going to see like this crazy flood. The real thing is going to be if these companies actually need to raise the money, because so many companies raised private capital in 2021 when it was just flowing like crazy. And then they saw that the market had turned in 2022 and they laid off staff to buy themselves some runway. And now they're starting to get toward the end of that runway, and they're going to have to make some decisions. Like, do we sell? Do we, like, can we raise more money? If we can't, then maybe we should look at selling. Are we able to go public? That is the sort of like ideal situation. But it's gonna be interesting to see how it shakes out next year.
Erin, thank you.
Yeah, thanks for having me.
Erin Griffith covers tech startups and venture capital for the New York Times. And that's it for our show today. What Next TBD is produced by Evan Campbell and Patrick Fort. Our show is edited by Jonathan Fisher. Alicia Montgomery is Vice President of Audio for Slate. TBD is part of the larger What Next family. TBD is also part of Future Tense, a partnership of Slate, Arizona State University, and New America. If you're a fan of the show, I have a request for you. Become a Slate Plus member. Just head on over to slate.com/whatnextplus to sign up. We'll be back next week with new episodes. I'm Emily Peck, filling in for Lizzie O'Leary. And you can catch me on Slate Money every Saturday. We actually have an episode out today all about the perils of facial recognition that I think you all might like. Thanks for listening.